All right, so when you're getting started in real estate investing, it can be really overwhelming because we use the words real estate investing, but the reality is that can mean a lot of different things and a lot of different strategies.
When you're first starting out, you can very easily flip-flop between which one should I do? Okay, so I'm gonna break down for you the single family versus multifamily in terms of rents, risks, and all the things, right? So you got your little single family home rent here and then got a little fourplex. Let's do it, single family comp to fourplex. All right, so here we are. We're super excited. We got a single family home. We've got our renter, already signed the lease, 100% occupied. We're excited to get those rent checks. They want to move out. Oh no, because now we're at 0% occupancy. And the thing is, when you're at 0% occupancy, you freak out a little bit because, well, the bank still wants the mortgage payment. Who's gonna pay it? There's no renter. So that's a risk, right? But let me calm you down a little bit. And let's just put you in a fourplex. In a fourplex, you've got 4 renters, 100% occupied, feeling pretty good. Now you got 4 doors, but one of them wants to move out again. But you know what? That's okay, because now we're at 75% occupied. Because of the 4 doors, 1 moving out, we still have 3 people there to help us pay the mortgage. So a little bit less stress when we're writing that bank check, right? But we obviously don't want that to continue. We want to hurry up and fill it and get back in there, but there's a lot less risk when it comes to occupancy levels on single family homes versus multifamily. So now I want to show you one more thing, economies of scale. Let's just say single family homes, all right, you've got 4 of them and you're getting $1,000 a door in rents. You're collecting $4,000, 4 doors under 4 roofs, cool. I'm feeling pretty good about this $4,000 a month coming into me. I know that's not necessarily the actual cash flow that you're getting, but let's just say it's $200 a door you're getting in cash flow. So that's 800 bucks. Pretty good, right? But let's blow that up. We blow that up and this is a fourplex. For the same amount of properties, you had 4 single family properties for $4,000. Now you've got 4 fourplexes. That's 4 fourplexes of 16 doors. $16,000, and let's just assume it's $200 a door on that one. So what's 200 times 16? $3,200. Here's the thing, you can apply that to a fourplex, but you can also scale it up. So what if it was a 5 unit, a 10 unit, a 12 unit? You can see economies of scale. Now you've got all those doors under minimal amount of roofs for the property manager to manage for you. It's easier to manage those assets and there's less risks. When you first got started, did you start in single family or did you start in multifamily?
So when I very first got started, the first thing I wanted to try to get was a duplex because I was like, yeah, that just makes so much sense, right? 2 rents. Well, I ended up getting a single family home that ended up being a fix and flip. So that was actually my very first deal. But then shortly thereafter that, I ended up starting to pick up a couple of duplexes and I got a whole bunch of single family homes. Then I started getting into bigger and bigger properties. And what I found for me at the time, part of why we focus on multifamily for teaching, is that the risk is just a lot lower when it comes to multifamily, when it comes to your tenants moving out. Like just what Jen was just talking about, it's really scary when you're a new investor. If you don't have a lot of money in the bank, which I didn't, I had like no money. You know, if you have a single family house and someone moves out, you're like, oh no. So when I was new, I actually did both and I 100% preferred the multifamily.
So how about you guys? Drop a comment below. Let us know. Like, what are you thinking? Are you thinking single family or are you thinking multifamily? And what clarity do you need in order to decide?
But there's really 2 primary strategies when it comes to investing in multifamily properties: stabilized or value add. So what's the difference between the 2? So a stabilized property is one that you're buying with tenants already in there. So you're basically buying something that's already cash flowing. So you find the property, you make the offer, you get financing. You're typically going to go conventional financing. You're putting down your 20% or whatever and closing on it, and you immediately have rents coming in. That's a stabilized purchase. The other strategy for 2 to 4 units, multifamily, is called the BRRR strategy. You might have heard of it. It's BRRR, and it stands for buy, renovate, rent, and refinance. And that is a very, very popular strategy with a lot of new investors that don't have a lot of capital, because it allows you to use a hard money lender to finance 80% of the purchase, but all of the rehab. And you basically go in there, you facilitate getting the rehab done using third-party licensed general contractors. You get the rehab done, you get a professional property manager to get those units filled. So now it's performing, now it's stabilized, and banks like that type of property. And now you refinance the property to get out of that hard money loan and into a lower interest conventional loan. But what happens when you refinance, because you raise the value of the property through all the renovations that you did, when you're doing a refinance at 70 or 75% of the new value, if you did your numbers right to begin with, it allows you to pull some of the capital that you put into it back out. So you can't usually pull all of it back out immediately these days, but if you put in, let's say, $25,000 all in to do the deal, holding costs and all of that, and you refinance, if you can pull back out like $18,000, yeah, you're leaving $7,000 on the property. That gave you $18,000 to go do another deal. And that's why the BRRRR strategy is just, it's so popular.
It's the millionaire maker. Because you can literally recycle the same thing of cash, like your same little wad of cash for a few deals.
I think of it as the millionaire maker because one of the things that happens to a lot of people if they leave their job or they didn't prepare for retirement properly, which it's almost impossible to realistically do that through a job, but you start realizing, shoot, I don't actually have enough to take care of me later. So I think the BRRRR strategy is great, the millionaire maker, because you buy a fixer-upper. Let's say you buy it for $60,000 and you put $25,000 into it. So you're all in 85 grand. Then you have your, different costs and stuff. So maybe you're all in 95,000. Well, if that duplex is now worth $130,000, well, basically you just created $35,000 of additional equity for yourself because you're only all in 95,000 and it's worth a lot more. Well, over the course of time, chances are it's even gonna go up even more. But even if it didn't, every month your renters are in there paying you rent. And what are you using to pay your mortgage? Their rent. So they're basically buying the property for you. So over time, they're gonna completely pay off your mortgage. So you're gonna owe nothing. So you have now all $130,000, that's equity. And chances are by then, it's probably gonna be worth like $200,000 or even more. But the millionaire maker, because you literally create your wealth because you're willing to go in and fix it up. Yeah, exactly. Sometimes people wonder, well, like, where should I start? Should I do a stabilized? Should I do a BRRRR? I'm not going to say you should do one or the other, but I'll just explain the difference so that you can make the decision that makes the most sense based on where you're at. A lot of our students in our mastermind, they come in with like, I want to do a BRRRR deal, right? And so they're making offers. And sometimes the markets they're working in are just really competitive for fixer-uppers. But like that's where like the bigger money is, that's what they want to do. Sometimes just getting into your very first deal, it opens up all sorts of doors. So sometimes they'll make the decision, you know what, let me go ahead and buy a stabilized one first, and then I'll do the value add BRRRR strategy. Yep. So with the stabilized, another reason people do the stabilized first is because the BRRRR strategy does take longer. It takes longer to cash flow. You're at least going to take a few months, where the stabilized one, it's pretty much cash flow right away.
Yep.
But what you give up is the equity play, because generally when we're buying a stabilized, well, we don't really buy them stabilized usually, but if you're buying a stabilized property, you're usually buying it for what it's worth. So you're not getting a big discount because it's not a fixer-upper, it's already fixed up. So,
but over time it'll gain equity anyway.
Exactly.
That's just a slower burn.
That's true. Yeah. So it's great. We have people in our program that will literally go stabilized BRRRR, stabilized BRRRR. It's totally fine for you to combine both, or just try both out and see what's a better fit for you.
And what we've seen is when our students are first starting out, it really does, you start where you're comfortable. So usually in the first year, they're looking at, all right, I want to get into 2 to 4 units, and they get some duplexes under their belt. Or maybe they get 6 or 12 duplexes under their belt. They get their first 24 doors in their first 12 months, and then they're super excited, but then they're like, they get the bug. And they're like, oh, wait a minute. And then by
bigger.
Yeah, I want to go bigger. And then by year 2, they've realized that, oh man, all those gains I made doing that value add strategy on 2 to 4 units, holy shit, what's it going to do on apartments? Because I think they're valued differently, right?
We have one of our mastermind members, Denise, and she's like literally on this exact journey right now as we're recording this. Like she got her first couple of properties, her first 5 units, right? Well, her first 5 units remote. She already had a duplex where she lived. So both of the properties that she ended up doing, one was a duplex and a triplex, were both the BRRRR strategy. So she basically had them getting renovated, rented out to refinance, so basically increase the value. Well, the value of anything 2 to 4 units, it caps out at whatever other properties like it have sold for. So the most you can ever get out of a duplex, triplex, quad as much as another one like that has sold for. So you're a little bit limited. It's still a really good place to start, in my opinion, because you get to learn the business on a smaller asset. But now Denise is like, okay, I've done that. And she's, 7 or 8 months into our program. She's like, I really want to get into apartments because I get it now. I know how to do it remotely. I want to start scaling. So now let's say that she takes a 10 unit property. And let's say it's also the BRRR strategy, but we don't call it the BRRR strategy for apartments. We call it a value add. Her ability to go in and increase what's called the net operating income. So the revenues minus the expenses equals net operating income. Every time she increases that net operating income, like what Jen was talking about, it's based on cap rate and then net operating income. So when you put those two things together, the amount of gain that you can get on an apartment complex, and this is literally anything that's 5 or more units, the amount of gain that you can get on that is, I don't want to say it's unlimited, but it's very close, right? Because the more value you can create because you're creating higher income, the more valuable it is for someone else to come in and say, I want to buy that cash flow that you basically created for me because you came in and renovated the place and raised the rents and cleaned up the management and you did all the things. Now your property is a lot more valuable because you raised the rents. In 2 to 4 units, the valuation doesn't change just because the rents went up or the expenses went down. But in apartments, 5 or more units, it does. So, Jen and I, we differ in there because she's like, I don't see the point of doing 2 to 4 units. Let's just go right to apartments, right? And I love apartments too. But for new people, I also like, building in the learning curve on the 2 to 4 units. But, you could do either, whatever you want. Jen's like, screw 2 to 4 units. I'm going right for apartments.
That's just me.
Anyway, you really have to do what makes the most sense for you. But we just want you guys to be aware that there's really different things and you have to be clear on what you're trying to accomplish. Is it your strategy to just quickly get into cash flow? Then you want to go stabilized, whether it's 2 to 4 units or apartments, go stabilized. But if you're willing to wait a little bit longer, you're willing to go through a little bit more pain as you're coordinating all this, then value add is so great for really building the value of the property, which it's going to pay off. It's not something that pays you today because you're not trying to sell it, it's a buy and hold, but down the line, man, it allows you to just go so much further, so much faster by doing it. That's why we like it, but both strategies are great.
They truly are. They truly are. It's about how much time are you willing to wait to build that wealth.
Yeah, and with single families, like you really have, you buy it, you rent it, hopefully it stays rented, and it also goes up just like with the market, but when the market tanks, single family houses also tend to tank, where multifamily tends to stay a little bit more stable because it's not subject to homeowners buying and selling. It's usually just investors.
Yeah, true. And actually when things go wonky on the single family side, everybody that, whether it's a foreclosure wave, whatever it is, everybody's got to have somewhere to live.
Right. I think if we would have just stuck to multifamily from day one, that would have made our journey a little easier, and we just want to make your journey easier as well.
But silver lining, if we didn't do it that way, we wouldn't be able to share with them. So
100%. I don't even begrudge any of the learning opportunities that we had.
Hey, and you know what they say? They say like the best time to have planted an oak tree was 20 years ago. But the next best time is today, right? So you may not have started 20 years ago like us, but you can start today. If you do want to get into multifamily real estate investing, but you're not sure what's the first step, the second, or the third, you can click the link in the description below and a member of our team will hop on the phone with you and talk about your goals, your resources, and how we can hold your hand and get you to where you want to be.
The other thing we want to tell you is that we have a free Facebook group. It's called Multifamily Real Estate Investing. So if you want to be around people that are like you, on the journey, looking to learn, come join us in that Facebook group. We do tons of free education and content there. And every week, Jen and I make ourselves available for a question and answer session. It's live, it's in Zoom, we're face-to-face. You gotta come to the Facebook group, register, go to events, and then we'll see you there. But any questions you have about real estate, we're there to answer them for you. All right, so if you wanna learn more from us, we have an amazing masterclass for you, specifically on the BRRR strategy. So if you wanna learn to buy, renovate, rent, refinance, and then repeat, go over there, click that link and watch that masterclass. We have so much to share with you guys. Thank you for being here and we will see you next week.
Bye.